Welcome to Macro Monday on Investec Focus Radio SA, a podcast about what's driving global and local markets. I'm Chris Holdsworth, Chief Investment Strategist at Investec Wealth and Investment. Every Monday morning, I'll update you on key developments from the past week and what you need to know about the week ahead. If you'd prefer to watch a video with the graphs and charts I referred to in the podcast, just go to investec.com/Macro Monday. This week, we're going to have a look at the latest market performance across the globe, and we'll compare South African returns to what's occurred in the US and Europe and Japan. We'll also have a look at the latest tariff announcements coming out of the US and what that likely means for US consumption and inflation. We'll also have a look at a range of central bank decisions over the past week and week to come, and we'll also have a look at the latest out of US reporting season. We're going to start off with the market performance. It's been a very strong patch for global equities. And it's interesting in two respects. The first is the scale of returns that we've seen over the past 12 months. Global equities up around about 20% or so. But secondly, how similar performance has been across a number of regions. US equities, European equities, Japanese equities, all up around about 20% over the past 12 months. And in that environment, South African equities have actually done much more, close to 30% in dollars over the past 12 months. Global fixed income hasn't turned anywhere near as well, and that's what one would expect. You're looking at about mid-single digits for fixed income markets for most markets across the globe over the past 12 months. But again, South African fixed income materially outperforming. South African bonds in aggregate up around about 20% in dollars over the past 12 months. So South African bonds doing roughly what US equities have done over the past 12 months. It's been a hang of a run for South African assets over the past 12 months. And in that environment, we've seen some dollar weakness because of increased concerns around the US economy, and gold has ramped very strongly. It's very unusual to see very strong rallies in equities and very strong rallies in gold, but that's what we have seen over the past 12 months. And one has to question the extent to which global equities can continue to run and gold can continue to run, both at the same time and each of them independently as well. On to the other themes for this week. We're going to start off with tariffs. There were a couple of tariff announcements over the past week. It seems that the US has now agreed a deal with both Japan and Europe, looking at tariffs of about 15%. If we look at the tariffs that were announced as of Tuesday last week and we aggregate all of them, that implies an aggregate tariff in the US of around about 20%. Now, to put that in context, that would be the highest tariff rate since the early 30s. And that makes it very difficult to estimate with precision what the impact is likely to be on growth and inflation. We simply don't have recent data to go by. The latest estimates suggest that the impact of these tariffs would be to push inflation up somewhere between 1 to 2% over the coming 12 months and to take about 1% off GDP growth. But we're going to have to wait to see, A, because we don't know what the tariffs are going to be in a few months' time, but B, there's a huge degree of uncertainty around those estimates. So it's pretty much a wait and see approach. But I think we can say with some confidence we probably should pencil in higher inflation and lower growth over the coming 12 months. We hope you're finding this podcast valuable. If you are, please take a moment to rate Investec Focus Radio SA on your podcast platform. And to make sure you don't miss an episode, please remember to follow us. We can say that US rates are restrictive. Interest rates in the US are well above inflation. But even so, there's limited scope for them to cut in an environment where inflation is likely to go up and growth is likely to come down. There is an FOMC meeting this week. The current market expectation is that there will be no change. The market is pricing in close to a 0% chance of a rate cut. And analysts agree. If we look at the contributors to the Bloomberg consensus estimate, very few of them, only 4 out of the close to 100 contributors to the consensus numbers believe that there's likely to be a cut this week. It is the widely held view that the Fed is not going to be able to do anything at this point and they're going to keep rates flat. What is interesting is that the market expects that there'll be about 50 bips worth of cuts by January next year, getting to an effective Fed funds rate of about 3.8%. And what's interesting about that is that 3.8% estimate number for Jan next year is precisely what was held in November last year. So interest rate expectations have barely shifted at all over the past 12 months, despite all of this uncertainty with regards to both growth and inflation. It's just remarkable how stable those interest rate expectations have been. If we look at growth in the US in a bit more detail, the GDP number for Q2 comes out this week. The latest Atlanta Fed GDP Now estimate, which takes into account all the high frequency data in the US, is for growth to be about 2.4%. The consensus number is not massively different at 2.2%. Now, bear in mind, growth in Q1 was negative. At first glance, this suggests quite a strong rebound in economic activity in the US. But we do need to bear in mind that the Q1 number was artificially depressed due to change in behavior around the tariffs, and like in the same way, the Q2 number is likely to be a bit higher than is actually occurring. And we probably need to aggregate the two together. If we do that and we have a look at the Q3 number as well, it does paint a picture of weaker growth in the US. And the current expectation is that it starts to pick up after Q3. But the current Q3 expectation of around about 1% does suggest that there is a slowdown underway in the US, and we shouldn't read too much into that strong rebound that we're likely to see from the Q2 number. The ECB met last week and they decided to keep rates unchanged. The ECB has cut by quite a bit more than the US, and they're now in a position where I think they're likely to keep rates at about these levels. The market is expecting one more cut over the coming 12 months. The BOJ also meets this week, and just like the ECB kept rates flat and the Fed is likely to keep rates flat, the BOJ is expected to keep rates flat too. But in contrast to the ECB and the Fed, the market is pricing in one hike from the BOJ by the end of the year. And we just need to be careful around that. We have seen in previous instances where the BOJ has hiked that it led to a strong risk-off trade across the globe. So we just need to be careful over the coming few months and monitor this pretty closely. Switching to earnings, it's been a very strong reporting season in the US so far. We've had about 160 companies report so far. 80% of them have beaten on the bottom line from the earnings front, which is very good. And aggregate earnings up around about 8% year on year. One does have to, however, question how much further the US market can rally, given that it's currently on a forward PE of around about 23 times, which is close to the top end of what we've seen in the past 30 years or so. A very strong rally, good earnings, but even so, we're now looking at a very extended forward multiple and getting us to the point where we think that there's more downside risk for global equities and US equities in particular at this point than there is upside risk. And finally, on South Africa, we had an inflation print come out of SA last week. South African inflation is at 3%. It was a bit below the consensus forecast of 3.1. South African inflation has now been around about 3% for 9 months in a row. There is ample scope for further rate cuts from the SARB. There is an MPC meeting this week. The current consensus forecast is that there is a 25 bip cut to come, and we think that's a pretty reasonable expectation in the current environment. And hopefully we'll get some more clarity around what the central bank target with inflation is likely to be over the coming few years at that meeting too. And that's where we're going to end it this week.
That's all for this episode. Do tune in next week for more investment insights from me, Chris Holdsworth, and the Investec Wealth and Investment team. If you haven't yet added us to your podcast feed, you can subscribe to Investec Focus Radio SA wherever you listen. And please take a minute to rate our podcast so we can surface this content to the broader investment community. If you want to see the graphs that I reference in the podcast, you can watch a video version of this recording at investec.com/Macro Monday.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of Investec Wealth and Investment International and should not be taken as advice, guidance, or recommendation. Investec Wealth and Investment International, a member of the JSE Equity, Equity Derivatives, Currency Derivatives, Bond Derivatives, and Interest Rate Derivatives markets, an authorized financial services provider and a registered credit provider.